If your credit application was rejected today, this wasn't a coincidence. For centuries, power had names: Rothschild, Rockefeller, Morgan. We were taught to look for power in families, in fortunes, in surnames. But today, power no longer stands behind a name. Power stands inside systems. Instead, algorithms decide who gets credit. Clearing and payment systems decide who gets to trade. Risk models choose who collapses and who gets rescued. In 2008, a risk analyst stared at the screen. Numbers turned red, not because the world was ending, but because a model said it was. The most important financial decisions in the world are no longer debated. They are not announced. They are executed in milliseconds. The real question is no longer who owns the banks. The real question is this: who controls the money? Because when power is written into code, it no longer answers to anyone. And the next decision may have already been made about you. Welcome to Financial Chronicle, where we uncover the mathematics behind power. Power was once visible, measured in factories, banks, and names. Today, power has become invisible. It has no walls, no flags, not even a clear center. Modern finance no longer operates through ownership alone. It operates through access. Who is connected? Who is excluded? Who receives approval? These questions now decide the fate of money. When a small business owner is denied a loan, there is no explanation, no debate, just a screen, a score, and a closed door. This is not randomness, it is design. Because in the modern world, power isn't owning money. It's deciding who is allowed to use it. And far fewer people control that decision than most ever realize. Money was once physical, counted by hand, moved with effort. Today, money rarely moves at all. It is routed. Modern finance no longer asks who owns what. It asks where the system allows value to flow. Payments pass through layers of software. Trades settle through invisible clearing channels. Every transaction waits for approval, not from people, but from rules embedded in code. A compliance officer watches transactions pause on a dashboard. No phone calls, no arguments, just automated flags deciding what proceeds and what stops. This is how power scales without force. No orders are shouted, no borders are crossed. Money simply slows or disappears from reach. Because once money becomes a system, controlling the system becomes more powerful than controlling the money itself. And very few hands ever touch that switch. In the modern financial world, ownership is no longer the main advantage. Access is. You can hold assets, capital, even wealth. But without access, none of it moves. Banks, exchanges, payment networks, clearinghouses, each one is a gate. And gates don't ask how much you own. They ask whether you are allowed. Access can be limited quietly. A delayed transfer, a rejected transaction, a temporary restriction with no timeline. A company CFO refreshes a banking portal again and again. Funds exist. Accounts are funded. Yet nothing clears. No explanation follows. This is how modern pressure works. Not through seizure, but through silence. Because once access can be removed without warning, wealth stops being power and becomes permission. Modern finance is not a marketplace. It is an architecture, built from protocols, platforms, and permissions, designed to move value efficiently and to stop it instantly. Behind every trade sits a structure, order-matching engines, settlement layers, clearing obligations that decide when money is final and when it is not. Nothing truly moves until the system confirms it. A trader sees a position marked filled, but the profit doesn't exist yet. Settlement is still pending. The system hasn't finished deciding. This delay is not a flaw. It is control. Because power in modern finance does not live in the trade. It lives in settlement. Whoever defines when money becomes real defines who can survive volatility and who cannot. In the past, credit was personal, a handshake, a reputation, a human judgment. Today, credit is calculated. Algorithms evaluate risk in seconds, income histories, behavioral patterns, data points most people never see and cannot challenge. Approval is no longer a conversation. It is an output. A young entrepreneur waits for a loan decision. No interview, no explanation. Just a notification, denied. The system does not explain itself. It does not argue. It does not reconsider. This is efficiency, but it is also power. Because when algorithms decide who receives credit, they decide who gets to grow. And when growth itself is filtered by code, the future stops being equal, long before anyone notices. Global markets are described as open, borderless, free. But in practice, modern finance is filled with invisible borders. Capital does not move everywhere equally. It flows where systems allow it, and stops where permissions end. Sanctions are only the visible layer. Behind them are risk flags, compliance thresholds, and internal controls that quietly reshape global flows. An exporter secures a buyer overseas. The contract is signed. The goods are shipped. The payment never arrives. Not because the buyer refused, but because the system paused the transfer. Because in a world without borders, the most powerful boundaries are the ones you never see. Every trade feels instant. A click, a confirmation, a balance update. But nothing is final until it clears. Clearing systems stand between agreement and reality. They guarantee trades and quietly decide which ones are allowed to complete. Most people never see them, yet they decide which markets stay liquid and which freeze without warning. A trader watches a profitable position reverse, not because the market moved, but because clearing requirements changed midday. Margins increase, positions unwind, losses follow. No announcement is made. Because when clearing systems tighten their rules, markets don't negotiate. They obey, and the next freeze never announces itself in advance. Risk is no longer judged by instinct. It is modeled. Thousands of variables feed systems that estimate probability, exposure, and loss. These models do not predict the future, they shape it. When risk thresholds are crossed, actions trigger automatically. Positions are reduced, credit lines shrink, liquidity disappears, a portfolio manager watches volatility spike. Nothing has collapsed yet, but the model says it might, so exposure is cut, not out of fear but compliance. Across the market, the same models react together. Selling accelerates, prices fall. Because when risk models act in unison, they don't just respond to crises, they create them. And by the time humans notice, the decision has already been executed. Financial crises rarely start with a collapse. They start with adjustments. A small change in risk tolerance, a revised margin requirement, a model updated quietly overnight. Individually, these shifts seem harmless. Together, they change behavior across entire markets. Liquidity thins. Volatility increases. Confidence weakens. An analyst notices funding costs rising slightly. Nothing dramatic. Just enough to make borrowing less comfortable. Others notice the same signal. Positions shrink. Hedging increases. The market tightens itself. Because by the time headlines announce a crisis, the system has already reacted. What we call a shock is often just the moment the structure finally reveals its limits. In modern markets, speed is not an advantage. It is power. Algorithms operate in microseconds. They react before humans can observe, let alone decide. A fraction of a second determines priority. Who trades first? Who exits first? Who absorbs the loss? Markets don't reward the smartest participants. They reward the fastest. A trader watches a price move and clicks to respond. By the time the order reaches the exchange, the opportunity is gone. Not because the trader was wrong, but because the system had already moved on. This gap is invisible, but it is decisive. Because when speed decides outcomes, slowing the system becomes a weapon. And in the next chapter, we'll see who gets to pull that lever. Governments still move at human speed. Meetings, votes, announcements. Financial systems do not. Markets react in milliseconds, while regulation reacts in months, sometimes years. By the time a policy is debated, the behavior it targets has already changed. This creates a permanent gap, not of authority, but of timing. A regulator reviews data from last quarter, trying to understand what went wrong. But the market has already rewritten its rules. Because power doesn't disappear when governments fall behind. It relocates. And as the gap widens, the real question becomes not who governs the system, but whether the system still recognizes governments at all. Power once had a face, a leader, a signature, a decision maker. Today, financial power is distributed, fragmented across platforms, protocols, and automated processes. No single person decides. No single office can be blamed. Responsibility dissolves into structure. A customer service agent reads from a script. They don't control the system. They only explain its outcomes. There's nothing I can do. That sentence has become the voice of modern power, because when no one appears to be in control, control becomes harder to challenge. And when authority has no face, accountability quietly disappears with it. Modern finance runs on rules, but most of them were never debated, never voted on, and never announced. They live inside compliance manuals, risk frameworks, and software updates, quiet changes that reshape behavior without public attention. These rules don't need enforcement. They enforce themselves. A company's transaction is rejected for policy reasons. No law was broken, no regulation violated. The rule exists, but no one can point to who wrote it. Because rules embedded in systems don't need agreement to function. And once rules operate automatically, the question is no longer who makes the law, but whether the law still needs lawmakers at all. In modern finance, data no longer informs decisions. It authorizes them. Credit scores, risk ratings, behavioral metrics. These numbers decide who is trusted, who is monitored, and who is quietly restricted. Data appears neutral, objective, scientific, but data reflects the rules that shape it. An individual checks their financial profile. Everything looks normal. Yet a transaction is flagged. A service is limited. A threshold was crossed. Somewhere. No explanation follows. Because when data becomes authority, numbers replace judgment. And once numbers rule outcomes, the people affected may never know which decision changed their path. Power once relied on force, armies, borders, sanctions enforced publicly. Today, power works through compliance. Rules are accepted to gain access. Forms are signed to remain connected. Standards are followed, not because they are agreed with, but because refusal has consequences. A company adjusts its operations overnight, not because of a new law, but because a platform updated its requirements. No resistance follows. there is no alternative, because compliance feels voluntary until it isn't. And when force is no longer needed to ensure obedience, power becomes quieter and far more difficult to resist. Markets are described as free, open, competitive, but modern markets operate within layers of constraints. Rules define access, models shape behavior, systems reward compliance. Freedom exists, but only inside boundaries. A trader believes they are making independent decisions. Yet their options are filtered by margin rules, risk limits, and automated checks. Choice feels real. Direction is not. Because a market can feel free while still being tightly guided, and once boundaries become invisible, participants stop questioning them, even as outcomes grow increasingly unequal. In moments of crisis, systems reveal their priorities. Liquidity is provided, lines are opened, support arrives, but not for everyone. Some institutions are stabilized within hours, others are left to fail quietly. This is not chaos, it is selection. A small business closes its doors. Across town, a financial institution receives emergency support. No announcement connects the two. Yet the outcome is linked. Because rescue is never random, it follows the structure of the system. And when survival depends on where you sit within that structure, failure stops being a mistake and starts looking like a decision. Power once relied on recognition, titles, reputation, visibility. Today, power operates without names. It does not announce itself. It does not seek approval. It functions through systems that appear neutral and technical. No leader stands at the center. No signature marks the decision. A user reads a denial notice. No person is listed. No authority identified. Just a result. Because power without names cannot be confronted directly. And when influence has no face, resistance loses its target, while the system continues uninterrupted. Financial systems do not collapse overnight. They evolve until pressure reaches a limit. Small adjustments accumulate. New rules layer on top of old ones. Complexity grows. Eventually, the structure becomes fragile, not because it is weak, but because it is tightly coupled. An engineer reviews a system update. Everything works as intended. Yet the margin for error is smaller than ever, because the most dangerous systems are the ones that appear stable. And when the next shift arrives, it will not look like a revolution. It will look like a routine update. This story was never about individuals, not families, not institutions. It was about structure, the rules that decide access, the systems that define legitimacy, the code that moves value without debate. When money becomes architecture, control no longer needs visibility. A user refreshes a screen. A transaction finally clears. Nothing dramatic happens. Yet an outcome has been decided. Because when systems control outcomes, power no longer asks permission. It simply executes. And the most important question of our time is no longer who has money, but who writes the rules money must obey.